I would love to hear what's happening with you guys and what questions you have. I see there are a couple of things in chat, but Chris did it. Okay, good. Everybody unfroze for you. And aloha, Mindy. Good to see you. What's new and exciting, Deanna, in our world of things? I think we have a couple of things that are coming up that people should definitely take part in, including we've got our remote ops thing that is, did we get that scheduled yet with Rich and Belay?
He's working on it today,
Okay.
so we should have that marked in. We also have our bonus call with Jillian Sadati is this week. And we have a new program being rolled out with Jim Dew that starts, I believe, next week. So that's a 4-part series. So that's pretty exciting. I did want to call out on Buzz because he was talking to us earlier, but I think Roland, you should hear. Buzz, why don't you share with Roland also kind of your call this week with Chris and how that's changing your business?
Well, sure. It's and Roland and he gave me some advice on this as well. So for me, I don't have a core business that I'm expanding, so I have to get a core business. My area of interest is aerospace manufacturing, which I don't know anything about. And after talking with Chris last week and some tips from Roland, I feel a lot more confident about getting into that sector. And Chris gave me some good advice on how to approach networking in that area. There's tons of businesses here in Southern California. So it raised my belief level significantly. And as a result, I've been able to start doing a better search and start reaching out. I don't know if that'll be the first business I buy because it may take a bit to get into it, but I'm really excited about it. And my belief level is a lot higher than it was 2 weeks ago.
So Buzz, that was the lists of the suppliers for Boeing and Airbus that we found, right?
Yeah, Boeing and Airbus, and my son works at Northrop Grumman, so I'm, working on the list for Northrop Grumman, which is a little bit more elusive, but that enabled me to find more businesses than I could ever possibly reach out to, in a year. So that's a good thing.
That's awesome. That's really great. And one of the keys to that is having a plan for that outreach. So I would definitely recommend, unless you've got the time, getting a VA or somebody to help you kind of go through that and start that initial outreach.
Yeah, my thought is that it's not going to be something I'm rushing into because I'm new to the industry. So Chris's advice was to kind of take it slow and grow into the industry, reach out to the organizations of aerospace engineers, find out what's going on, maybe get some introductions and kind of gradually grow into it as I become more familiar with the industry. And I thought that was very wise counsel in that respect.
Every so often he gets it right.
Yeah. It's once in a while, right? So, it's been very helpful.
Great. Okay, good. Excellent. That's really, really great to hear. So what else is going on, guys? What questions do you have? This is your time to get any questions answered, talk through any deals that you're working on, anything like that. So hit us up with what you would like to chat about.
And Roland, this is just so that everyone knows we see a lot of new faces. It's because we have a bonus week. This week is for our new people that just joined us. So welcome to everyone that's new. So if you guys are seeing new faces, you guys should be connecting. And as far as Roland just said, this is Q&A time. So if you're new, the way this works is you can post your questions in the chat box and Roland will answer them. So welcome everyone that's new. We're excited to have you all here.
Yeah, absolutely. And I see that George, you have a deal. Let's chat with you about what you got.
Awesome. Hey, hi Roland. So there's this guy that I know for 30 years. We haven't kept in touch the last decade or so. So he reached out to me. He has a fund, $50 million fund that he gives out loans to real estate investors. Mm-hmm. And he's been running ads on Facebook, getting leads, but he's not happy with the guy that he has. So he reached out to me. He says, I don't care what I need to pay you. I don't care what, I just need a steady stream of leads. Now I started talking to him about all the other things I could bring to the table. And I told him I was going to create a funnel for him just so you can see what I'm capable of.
Smart.
How do I take it from that, what we're discussing now, to an equity deal that he would be super interested in participating in, offering me?
Well, I think the thing to say is that, what I like to do is, and I do this too, if it's somebody that I want, that I've identified I want to work with, is like, I like to add value first. So let me show you what I can do. And then let's talk about how we might work together. Now, if you want to, in advance of that, say, listen, what I really am much more interested in than being a service provider to you is to, work with you as a partner. And I'm willing to invest in that relationship to show you what I can do. Is that something that you're open to? Because if he's not open to it at all, then, that will define your initial relationship as more, transactional. And if he is, then that'll tell you that maybe you would be more flexible on kind of proving that you're, that you can do what you say you can do to make things go for him. So that to me is a good litmus test at the beginning, is just find out, is it something that they're open to at all? Because if they're not, then maybe you'll be able to gain leverage as you do good things for them. And they'll say, oh gosh, I was wrong. I have to have you as my partner. But if not, initially, it's just going to tell you it's going to be a little bit longer. Does that make sense?
Yeah, I think so. I don't know how to bring it up without sounding, arrogant, or that, I want a piece of the,
What's his
I
name?
want to the relationship, so I want to.
What's his name? First name?
Dennis.
So, hey, Dennis, listen, I'm really excited about doing this funnel thing for you. I was actually, thinking about doing something like this myself. And I was just wondering, is this something that you would ever consider, working with somebody on as a partner on, if they were able to bring the leads and then you kind of handle the rest of the stuff? That's the conversation. It's not threatening. It's not demanding. It's just curious, right? It's an explorative question.
I see. All right.
Does that make sense? Is that something you think might work for you?
I'm definitely going to try it. Yeah.
Are you nervous about it?
A little bit. Yeah. I mean, it's easily 20,000 a month just on the service side. So I don't want to lose that if he gets, defensive.
Well, then why don't you start by having the $20,000 a month, do that for a couple months and have the lead flow going so that he can see you can do what you say you can do. And then open that door after that. Just say, hey, I had been kind of thinking about this anyway. And it looks like you're taking really good care of these people. Would you ever be interested in having a discussion about maybe working together on a partnership basis?
Bring it up later. Yeah.
Yeah. Then it's always good to prove your value first, right? It's always good to prove your value first. That's really one of the things, that and not wanting to, just have a bunch of people throwing deals at me that never turned into anything, because most don't, right? When they're coming cold. That's why I do the consult thing, because then they know they've got me. They know, number one, they know that they are investing and have skin in the game. I know that too. Number two, it's something that allows them to constrain my participation initially to a fee for services thing. And then I go in, razzle dazzle frazzle, and show my value. And, that's it. So I think I like that. And so really if you do what we're talking about, you're kind of doing the same thing. You're saying, because I don't talk about equity generally on those going into those calls. And then when I go through the call and provide the service, then if it's something I want to do and I have to ask, very often they'll ask me, but if I have to ask, it's like, hey, would you ever consider working as a partner? There's not really much threat to that. And I don't think you're going to have them say, what, not only am I not going to do that, but I don't want your stupid leads anymore. You're fired. Right. I mean, that's very unlikely.
All right. Thanks.
Cool. Okay. Let's see. What else do we have?
You have one here from Gerald Welch that says, Roland, on your no money out of pocket strategies number in excess of 100 using 80-20-90-10 rule, what are the most common and successful methods?
The easiest ones to understand are the first ones that I give in the challenge. Those are kind of the most basic. And then everything else, if you look at them, a lot of them are fallback positions. So then they're arranged and presented that way. So what I would say is that it's really good to get very familiar with all of those. It's kind of like if you play chess, there are opening moves and there's mid game, middle game, and end game things that you should know. If you're a Scrabble player, then there are like a few hundred 2- and 3-letter words that you should know. In this game of M&A, there are a few hundred strategies that you should generally be familiar with, to do this. Now, if you look at all 216 of them, then and go through them, then you'll see that there are several, like there might be a group of 5 that is do this as you're open, then fall back, fall back, fall back, fall back. So those are all kind of derivative of the first move that you might make there. So I think that as you go through your deal, it's not like for what the payoff is to spend an hour or two going through those every single time you have a deal to say, check, 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 check. These are the ones that apply to me. I think it's really worth doing. And one of the things that we're working on adding to the Deal Done software is to have all of those in kind of a check box thing, so that as you're reviewing your deal, you can kind of pick the ones that you want. And then those are the ones that will show up over in the strategy thing. So that's being worked on. There's some that is being worked on for that version. And also the data that you input, taking it over to a separate page where you have the not just the deal stack part, but the funding, the service stack, basically, so that it tracks. It'll say, okay, well, I said that I was going to have a factor of the accounts receivable, and then you say that's going to be at, say, a 6% interest rate. Then it'll basically calculate that and put it in, the payment stack as well. I guess that's what I should call it. It's a payment stack, so that then here's the profits, and it'll take the SDE or EBITDA from the first part of the sheet where you put it in, pull it over to the payment stack, and then import all of the other information on what the payments are going to be. So those things are coming, but right now, definitely going through the list in the document that has the 216 strategies, listening to that video. There's 3, I think, 1 hour-ish videos where I went through all the strategies. That's really the core of doing this. So and what things you're going to use. I mean, I always like seller financing. That's a huge thing. If you can get it, that knocks out a huge part of the deal stack. And I like the pre-closing things more than the post-closing things. So I've identified all the pre-closing things first, and then a set of things that can be used for both. And then the last strategies are the post-closing ones. So the pre-closing ones, I think, are generally easier, because then you've got it done without even having to close the deal. Like in your offer, then you can lay everything out like you want it to be. So that's, other than that, man, it's just going through it and seeing what applies to your deal, and then picking the ones that are the most favorable in terms of meeting whatever terms you've got on the payment stack.
Okay. Did you want me to read the questions, or did you want to look at them?
You can go ahead and do it. It's actually easier for me.
Okay. eTag Project says, I'm looking at going through a learning process with small opportunities and discussing an opportunity. It is a small software company, and the founders have practically retired and not developing the company, but just living off of the $250K annual maintenance fee. They're getting on a recurring basis. So if I can take this over, I can make a big difference for them. What do you think I should do to approach this?
Yeah, we've had a few people do that, and the biggest thing there is just making sure that it makes sense for you. So if you want to figure out what is a purchase price for that. So would they be willing to sell it for one time what they're getting out of it? If they're making $20,000 a month profit from it right now, would they sell it for $240,000? If they would, then that seems like a good deal. Is there, if they let it go and they're the programmers, how hard is it to keep it up? What are the costs going to be to replace them doing that? Is that something you can do, or do you have to hire somebody? If you have to hire somebody, then that's going to figure into the math of, just like when we did a couple of examples and said, we've got to think about having an $84,000 manager, what's that person going to cost to help do that? I think it's a cool deal. And like I said, we've had a few people do those. Do you have any specific questions? You want to pull them up and see if there's any more specific things than that, Dee?
Yeah, if you have any more, let us know. Scott Shaggery has a question about your presentation last week. Do you want to go live on that one?
Yeah, sure.
Yeah, sure.
Scott?
Hey, so it's a follow-up question, obviously, on your presentation around, I'll call it the horizontal funnel, and then also the follow-up with the wheel and things that you went through step by step, which was great.
Okay.
My follow-up question really is around how you go ahead. Let's pretend you did that to me. I said, oh yeah, that's amazing. Yes, yes, yes. And
Can you, just so everybody is on the same page and caught up, will you just say did what specifically?
in terms of for context and background, you mean?
Yes, exactly. Yeah.
Yeah. So last week, for those of you who weren't on it, Roland gave a presentation around, I think of it as a horizontal funnel, but basically in a nutshell, it backdates from today to 2022 and talks about a growth trajectory, talks about a falling off trajectory, where somebody is in that, kind of historical process, and then how we can, using the wheel, go ahead and either grow a firm, help a firm grow, etc. Basically, it's a pitch with what our value proposition is in a nutshell, and use that to then get to a consulting session if someone wanted to move forward with that. Mm-hmm. So that's the quick summary. So the piece of it that I just wanted to understand before I get to that point myself, hopefully soon, would be around how you negotiate depending on the size of the company. Let's say $1 million of revenue versus, I don't know, I'll give it an extreme, 50 million in revenue, where you look at, your earn-in, what your consulting fee on a monthly or quarterly basis would be, how you judge that, and again, build that out as you're thinking about it, as you negotiate with that team or that person, that company, please.
Sure. Yeah. So it depends, as the answer always is, on is it for me something that I look at as a longer term play or a shorter term play? That's the first thing. Because if it's a longer term play and I don't care about really getting cash from it in terms of a consulting thing, then like I'm looking at it as truly, this is going to be a partnership. And the range you gave is good because I have two of those things right now. And the one that I think I was talking about last week was they're doing about $1 million a week. So 50-ish million a year. And they're working at about a 30% margin. So there's about 15 million in EBITDA. And that was an initial consult, 25K. We spent an hour and a half on the phone. He said, this is it. I totally want to do this. I get it. I get the value. What's it going to take to make this happen? And I said 5 to 10%, depending on what you want me to do. Now, what I know is that that's going to be done as phantom equity, meaning that I'm going to not take the actual ownership on the day that we sign the contract, because I don't want a tax consequence of 5 or 10% of it's, I value the company wherever you want, but at a 15 million EBITDA, it's going to be hard for that to be less than 50 million. So, do I want to pay taxes on, a $5 million income event to get that equity and not have the cash yet? No. Right. So by doing phantom equity, which I don't think I've ever completely explained the way that works. And Deanna, will you check and see if we have a phantom equity agreement in the documents? Because if we don't, we should definitely add one. And
we don't.
Yeah, let's do that then. Let's put one of those in there. So the way that phantom equity works is that you don't take, you sign a contract and it says, look, I'm not going to take the equity right now. I've got this ownership interest. There's also another way of describing it is a profits participation interest. So what you get is you get to participate in profits pro rata to your interest. So this guy is making $15 million a year. So I'll have 1.5 of that. So I know I've got that built in. Now, I don't know how much of that he's going to distribute, but if it's going back into the company, I mean, and not all of it's for sure going to go back into the company, but if he was putting it all back in the company, I'd be okay with that because we're going back in pro rata. If he distributes 10 million and keeps 5 in the company or vice versa, then, I'll get my 10% of whatever gets distributed. So I know I've got some cash coming as long as any distribution is made. So if I want distributions, phantom equity takes care of that, or profits participation interest, either one. So two things, Deanna, let's do a profit participation interest and a phantom equity. And then let's do a call with Grant about explaining the difference between the two and why you might want one or the other. That'd be actually a really good training. So, so if you, and that's that, just remind me to schedule it and we'll get it done. So now I know that I've got that that cash that's going to come from that. And then the difference, like I tell him literally, just like I tell you guys, it's generally on a deal like that, we're consulting for exit, which is really what that's about. I'm going to help him with some growth stuff too, but it's typically in the 5 to 10% range when you're looking at helping somebody with an exit. They've already done the work. They've built up a great company. That's the other thing, is that, that's a pretty advanced company. He came to me because he had an offer, and we basically went through it. And I just said, man, that offer's leaving so much money on the table. I wouldn't do it. But if you want out now, and it's always thinking about what's best for them, right? Is if you want out now, then cool. But just know that you're trading whatever you're going to do with the money or your quality of life that you don't have now, that's going to give you, for probably $100 million. And there's nothing wrong with that. It's just, that's what I see. And here's why. So, in that deal, I said, what do you want me to do? Because he said, what's the difference between the 5% and the 10%? And I said, well, it depends on what you want me to do. And he said, well, I want you to talk to the people that we're negotiating with. I want you, to be part of all of those meetings, and, and with the attorneys go over, the strategy and that kind of stuff. And I said, well, that's a heavier load. And also he said, if you have some contacts in the industry that I think could help us make even more money. And I said, yeah, okay, well, if you want me to do that, then that's on the 10%. And he's like, totally cool, I'm in. And he's been bugging me, by the way. Even this morning, he texted me and said, I want to do this deal. Send me the agreement. I generally like to wait about 10 to 12 days from when they say they want to do it before I send them the agreement, just so that I give them the chance to back out if they want to back out without having to have it be a big deal. So I really want to know that they want it. That is something that I have seen a lot of the higher end consultants do, by the way, is that, like, when you're taking equity, just be sure they really want to do it before you lock it in. Then I know I'm in at, I know I'm in for probably a $10 to $15 million lick at the end when we exit. So that's how I looked at that deal. And on the upper end of that, I think it's 10%. I think 10% is very, very fair, given all the stuff I have to do. I know that I'm in for cash from the distributions because of doing it as a phantom equity deal. So, that's how that deal works. Now, going to you said $1 million company. So if I look at a deal like that, then I'm still going to do the upfront consult thing, right? Because that's kind of how I vet whether somebody's serious or not. And then on the equity on that, I'm going to, or cash, either one, I'm going to say, what's that likely to yield? So let's say that it's a $1 million company and it's operating at a 20% EBITDA. So they're throwing off $200,000 a year. If I have 5 or 10% of $200,000, I want to be respectful of that because that's good. But, the truth is that's not going to move the needle for me. It's not going to be motivating for me cash wise. So then I might say, in that case, my threshold to get involved in a deal like this is it's got to be producing about $10,000 a month. Otherwise, I just can't give you the time. So it would actually be a no, right? Because I'm not going to take 90% or 80% of what their net is to do. I guess it'd be 60%, right? 60% of 200 would be 120. But I'm not going to take more than they are. That's not fair. They're working in the company. So that's going to control it a little bit, is for you to say, given, what's the opportunity cost for me? So how much time am I going to have to give to this? And is it going to be worth going on? And we're in the middle of doing a lot of that right now. I've raised the price for that consult from 18 to 25K, just over the last few months, because I don't want as many of those, because as much as those are cool and they do generate deal flow, I'm also, for the people that just take the consult and go on, I'm building their brand, and that's taking me away from things that I can do that make a lot more money. I had another deal that was paying me about 25 grand a month, between 300,000 and 400,000 a year, but I'd say the worst is about 25 grand a month. And that's one that I'm letting go at the end of this year, because as wonderful as it is, it takes 16 days a year of my time to do it. And while that sounds cool, 300K for 16 days, that's actually, I'm losing money on that given what I could do other ways. So for those people, I had to say, hey, look, I can't continue to do this because it just doesn't make sense. So then it's okay, well, what do we want to do? Because I'm a 30% owner of that one. And I said, I just can't do it anymore. So I went out and found somebody who I'm meeting with immediately after this call to acquire that company and do all of the things. They're acquiring 50% of it. And they're going to do all of the things that I and my partners were doing before. We keep the 50%. It's going to cut our time commitment down to probably 8 hours a year. And we'll have 50% of it, and we will have exited it and have the ability to grow it still to exit for more. So I know it's a really long answer to your question, but I want to try to be helpful. So it's a lot of it comes down to what's the opportunity cost and what do I need as my minimum thing that I'm going to get for my time, which if you want to calculate it on an hourly basis, like I've got a consulting thing with somebody, it's 50,000 a quarter. And when they said, we want an ongoing thing. Well, I know that my 4-hour deal is 25K. So that's what, 62.50, right? An hour. So basically when I calculate, I was like, well, what do you want for that? And they're like, well, we want a meeting a quarter. I'm like, okay, that's easy. That's 25. And then we want to be able to call you whenever we need to talk. And then, maybe have an hour or two meeting a month. So I said, okay, cool. $50,000 a quarter. That was based on what the hourly rate is, just saying, I know this is how much time it's going to take. And by the way, they said, and we think we'd like to have you come into the company. It's a $40 million a year company. So for me, it's kind of part of that is where does, in defining your ideal customer profile, it's like, how much money do you need to get for you to be happy given the other opportunities that you've got? And then calculate that as your consulting fee for like the half day thing, and then figure that your hourly rate on that. If it's $4,000 consulting fee for 4 hours, then it's $1,000 an hour. And then just use that to price the cash you need to get out of the deal based on your time, and then figure the time commitment. Just if you read, I did a post on the on calculating this one time, but basically I'd say, look, to do the things that you want to do, I'm probably going to need to spend 20 hours a month. And I'm $4,000 for a 4-hour consulting block. So it's $1,000 an hour. So that's effectively $20,000 a month or $240,000 a year. And we're going to do a 1-year deal, and the company's valued at $1 million right now. So I'm going to provide $240,000 of services. I want 25%. That would be what I would say. If I was taking strictly equity, then I want at least 25%, but my risk of taking equity versus taking cash is pretty significant. So I prefer, I think I called it the equity gap multiplier, now that I think of it, right? So I'd read that, and then I just go through the math with them and say, so, basically it's, I typically like to get a 2X on what I'm doing. So you're talking about 50% of the company. If I'm going to come in and spend that much time, that's kind of what that looks like to me. Now, if you'd like to hybridize that so that it's not quite as much, let's split the difference. Let's say that you pay me 10 grand a month and instead of 20. And that means I'm investing effectively $120,000 in the company, which would only be 25%, right? So 10K a month and 25%. That's how I kind of do the math into that. Does that make sense?
Yeah, no, that's really helpful, because it was just, where I am, or a number of us, myself, I'll use where I am right now versus where I might be a year from 18 months from now. So to have that framework is really, really helpful. And I won't ask a follow-up question. I'll wait till Grant's follow-up, we have that presentation around, the documentation and things like that and so forth. But that's great. Thank you very much.
Yeah, you're welcome. It is, it's truly an evolution of how things are going, and to me, everything starts with your time. Most precious asset you've got is your time. If you are not fully utilizing your time, then to me, it makes total sense to invest in deals, invest more time in deals to find them. But then as things go and you find, God, I've got, and you guys, I know some of you have told me, it's like the deal flow is increasing. As it gets more, you've got to find a way to still deal with it, but also not be overwhelmed by it. And the easiest way to do that is start saying, it's a paid consult. And then, which also is nice, because I think was it George? Was it you that did the $7,500 consult? Yeah, that's like, so then you get like George and say, hey, it's $7,500 to look at it, and then that feels much better, right?
No, cool. Thank you very much.
You're very welcome. Okay, Dee, what else we got?
All right, this one is from Josh Wilkerson. He said, hold on. I like implementing marketing systems. In my eyes, the product doesn't matter too much as long as there's room for offer development, obviously taking ethics into consideration. In light of that, how would you go about defining what industry to pursue acquisitions in?
So I talked last call or call before last about it. I think that I think this would be good to get some feedback from George, because he's kind of in that situation too. He has a digital marketing agency and isn't particularly, he's industry agnostic, and has looked at a couple of things. George, how do you, since you're in that specific industry, how do you go about deciding whether you're interested in something or not industry-wise?
That's a tough question. Yeah. Well, I have to have some kind of interest, meaning, have I done any deals before? Have I had clients, I feel comfortable in that space. If I've never done anything in that situation, in that specific niche, then, okay, have I done something similar? Do I see opportunities? Can I grow the company? I mean, is there a company that has, that's more where the customers come in for, let's say, from Google, and I could just hit it hard with Google ads? Or is it more customers are laid back and you have to attack them on Facebook? So depending on where the customers are and where you have to go find them, how easy it is, that would make it or break it kind of a deal.
I like it. Yeah, I think that's good. I will go briefly, because I don't want people to get bored that heard this before. But let me see if Deanna's allowed me to share or not. It's always, yes, she did. I love it. Okay, let's see. Do that. That and that. That and then that. Okay. See. Okay, great. And then go down here. This. Okay, great. So the couple things that like, so to me, there's the first filter, which is the PFM filter for me, and that's the people, fun, and money. So do I like them? So if you don't, then the answer is no right off the bat. So that's question one. Then if yes, we go to question two, which is, am I going to actually have fun doing this? That's really, really helpful, because if it's not fun, you won't want to spend time on it. And then I say, can I make money? So the how can I make money industry-wise, I think, goes to the second filter question. So the second filter question is industry and success. Sorry, industry success. So to do that, then I'm going to look at JWIT intelligence and Trend Hunter and other sources, Pew Research, trendwatching.com, and then my questions there is, One, do I have A, experience, B, knowledge, which is important to distinguish from experience, or C, access to partners with experience or knowledge. Right? If I've got that, if the answer there is no, then it's done. If it's yes, then it's, is the industry growing? Okay. So now, then that's going to take me over to, my dogs are howling in the background. That's how bad their lives are, because they're not inside. It's so funny. So I'm going to go here and I'm going to say, let's see, fastest growing industries 2020. And then I'm going to look at these and see, is there anything like this? This is because I haven't picked anything yet, right? If I haven't picked anything yet, I'm going to do it this way. If I have picked something, I'm going to Google that industry, right? So if it was aerospace, or you guys are doing, a couple of you guys are doing the industrial Internet of Things. So if you had decided you were looking at that industry, should I go into that? The opportunity's already presented itself. Then I'm going to say industrial industry of things growth rate, and see, is that something that's growing, right? If I don't know, I have no clue what I want to do, then I'm going to say, okay, first, I'm going to go here and say, what are the fastest growing industries? This is IBIS World, which is something I subscribe to because it's absolutely worth it. And I need to put that, I'll add that to the sheet I was doing. Won't let me share both at the same time. So then I'd say, okay, I haven't got a clue what I'm going to go into. Am I interested in online grocery sales? It's awful. The margins, I know for a fact, are 1% or worse. So that's horrible, unless you're in specialty. Cough and cold medicine sounds like regulation from the government. Don't like it. 3D printing and rapid prototyping services. I'm not sure about that, because that sounds like I could get obsolesced out. Online pet food and supply sales. I love that. It's growing at 28.5%. Great industry, lots of opportunity there, low barriers to entry. I can formulate my own stuff. I can buy and acquire within it. So I like that. Hydraulic fracturing services, not sure about the regulation, but would be curious about that. Autonomous underwater vehicle manufacturing sounds expensive. Stock and commodity exchanges, related businesses around that, and info would be great. So I'd be thinking about that. Medicinal and recreational marijuana growing. I am in that business on the infrastructure side. So that's the other thing I would say too, is, when you're looking at, can I go into, oops, I don't know why that happened. Can I look at going into this business and be on the infrastructure side, even if I can't afford, or or I don't like like in the medical marijuana business, I don't like the regulation and the lack of certainty there. But I know that if I'm in the formulation, extrusion, packaging, any of those, I'm a step removed from that. So I'm not really concerned about it. Thermometer manufacturing, that would be interesting to me as well. Massage franchises, that would be interesting. So that would be my very, very, very first thing, just looking at my first Google results. And then I'd go through all of the things that come up. So this is the view the list of the top 25, unlock the top 25. I think it's probably, you just put your email in. I'm not logged in right now, but then I just go through and say, okay, here's, this is 2019. Don't care. 8 industries for starting a business. Don't really care about that. 3 of the fastest growing in 2020. This is from national funding. And I would just, look through here and see what comes up. Fortune magazine, love that. 100 fastest growing companies. I'd take a look at that and say, what are the industries that those companies are in? And that's my kind of preliminary research. And then I go back over to here and say, I added IBIS World. And So is the industry growing? I'd make the list of those things, and then I'd circle back, because now we're saying I didn't know what I wanted to start with. I'd circle back here and say, do I like the people in that industry? There are industries where I happen to know I don't generally like the people, right? Then am I going to have fun doing it? Can I make money? And then I basically hop back from there up to here and say, do I have experience or knowledge or access to experience or knowledge? And then that would be a path for doing that. Does that make sense?
Yes, it does.
Cool. Josh, I know it was your question, right?
Yes.
Yeah. So does that helpful?
Yes, it is. I like the formulaic approach of being able to systematically go through and pick what you want to do.
Cool. Okay, great. All right, Deanna, who's next?
All right. Linda. Yep. So Linda asked, can you please discuss debt coverage ratios and how to apply that when evaluating acquisitions and leveraging assets, cash flow, et cetera, to do Epic style LBOs?
Yeah, the easiest thing there is going to be not that one, this one. The easiest thing there is going to be to pick your industry. So let's say that I am in the that's a manufacturing business. Then I'm going to say manufacturing industry debt ratios, and I'm going to find out here. They're giving it to you right in the answer box, right? So a debt to equity ratio of 3-to-1 would not be uncommon in the manufacturing sector. However, the majority of manufacturing companies have lower ratios of 1.6 or lower. So I'm going to look at that and then say, that's generally where they are. I'm not going to be afraid if my if my debt to equity ratio or any of the other debt ratios that you're looking, like if you're looking at current ratio or anything like that, right? Any of the different ones. I'm not going to be afraid if it's less good immediately after the deal, as long as I can service the debt, unless there's some covenant that is in a bank document that is going to carry over that I need to maintain, Linda. So that's, I'm going to look and see what are the debt to equity and current ratios and such that are common to the industry. Just like we do with multiples, right? What's the industry? What is it looking like in the specific one pre-acquisition? What will it look like post-acquisition once I get the payment service stack done and I know how much it's going to cost me post-deal to acquire this? Then I'm going to say, does that violate any covenants with banks or other lenders that exist that I am taking over that aren't going to be liquidated as part of the acquisition? If yes, I got to fix that, negotiate something with them, make the deal better, get an investor, whatever. If it's not going to violate, or if there's nothing like that exists that would be violated, then I'm going to say, can I actually cover the debt? And do I have what I believe is a safe enough margin between what it's costing me to service everything that I have to pay to complete the acquisition and where current income is? If the answer is no, and you've got to rely on growth, that's a bet I'm seldom willing to make. So I would probably then go and look for, to do integrator equity or a PPM or something else that would give me the ability. Maybe I'd buy less of the company now and take an option on, maybe I'd buy 60% of the company now and take an option to buy the remaining 40 later, just so that I wouldn't have to squeeze myself into a box that's that tight and give me no margin. Does that make sense?
Yeah, no, that's great. And actually the question that you just answered previously about choosing an industry is very related to this. The previous description, which was awesome, thanks for that, was very qualitative in nature until you get to the point where, and by the way, does it make money? Just what I'm really hoping to get my mind around is the financial metrics that make an acquisition, other than having it asset rich or cash flow rich, or have 500,000 which ways you can leverage to have the money not come out of pocket.
Yep.
What are the other financial metrics that you need to be looking at? Boom, boom, boom. Like high gross margin businesses, one thing, but of course if they have a low expense structure, that's another thing. Like, are there any particular financial metrics that you like to see right off the top, regardless of whether it's a passion industry, the people are great or terrible, and all that stuff that just, would write stuff off pretty quickly?
Yeah, if I get my choice, if I can have anything I want, then I like 20% compound annual growth on the top line. I like to see a payroll not taking more than 20% of the total margin, basically. I like to see a margin of 20% after all of the expenses, including SG&A. And that's post me looking at the financial statement line by line saying, I need this, I don't need this, I need this, I don't need this, right? So can I get it to 20%? Because if I have 20%, then I've got plenty of room to roam. And then other than that, I don't really care about anything else other than, can I sell the thing at a 5x return within ideally 3 to 5 years, which always seems to be 5 to 7. My goal is 3 to 5, but so far, if I had to say, I'd say it's always been closer to 5 to 7.
So that's awesome. Thanks. If on the margin, you're talking about pre-tax profit,
Yes.
there,
Yeah.
right?
Yes.
At 20%, you're looking for 20% pre-tax profit.
Correct. I'm talking about EBITDA.
Yeah.
Yeah.
Okay. Thanks.
All right. And then the next question was Scott Walton. He has a deal real quick. You want to discuss that, Scott, real quickly? Scott?
Sure. Yeah.
There.
Thanks, guys.
Mhm.
Yeah. Hey, Roland.
Hey.
So I have this deal here in Texas. It's a trucking. They also have a pit for aggregate. They do a lot of roads as well, some construction. I'm looking at
25% margin. That's nice.
Yeah, it's not too bad. The husband passed away. Now the wife and son are running it. She is in her mid to late 60s and she just wants out.
Okay.
So I caught him at the right time. My question is, on an APA or stock purchase,
Mhm.
I'm finding getting lending tough if I wanted to go the lending route. Now I think she will carry paper, but I'm just looking at all my options before going in. I'm in lending, so I have my bank willing to do it, but they really don't want to do it under an ABA or an APA with a new entity.
Yeah.
So if I did a stock purchase, I'd be able to use the assets.
And for anybody that doesn't know, APA is asset purchase agreement, SPA is stock purchase agreement. So he's talking about asset sale versus a stock sale. Go ahead, Scott.
So, I'm kind of in a dilemma there. And also,
So tell me what the dilemma is there, that you would like to do an asset deal, but they're saying basically we'll only lend on a stock deal.
Exactly. Yeah.
Yeah.
So
go ahead.
Well, I was just going to ask you what you would do in that situation.
Well, I mean, if that, well, first I would talk to different lenders because there are lots of asset deals that go through, and they are, if you are effectively transferring every asset over. So it's that, it seems like maybe that's the only kind of deal that they do, but that usually isn't something that comes up as a constraint for us, particularly for a company that's operating on this kind of margin with that kind of history. And it's like, so you guys understand, bankers, that the business is coming over here, right?
Yeah.
So it has a continuity of interest. And all of the assets are coming over. So, I think you just have to talk to a couple of different lenders first if you're going to go the lender route, because there's no reason that they wouldn't make a loan on that. How much is the purchase price going to be?
Well, we're still talking about that. I mean, I was planning on offering, there's 2 pieces of real estate, a ton of equipment, but I think the equipment's kind of old. So I was going to offer them right around $2 million.
Okay. So, $2 million. What's the real estate worth net of loans?
Worry about $500,000, 600,000.
Okay.
Not a whole lot. It's near Louisiana, so it's kind of rough real estate out there.
So one thing you could do is put together asset-based lending deal. So talk to your bank and ask them if they have an ABL department, and then chat with those folks about it and see if that's something that would work, because you have a lot of hard assets in this business. So that'd be something I would look at. If you're comfortable with a personal guarantee and want a simple thing, but it takes a long time, you could look at an SBA loan on that. That's a prime candidate for seller financing for the down payment and SBA on the balance. But
Yeah.
then the rest of it is just going through all of the, all the different ways you can fund this thing without, without a bank, which is a lot.
Yeah. Yeah. And I think they're pretty negotiable. So, I mean, she said she's open to carrying paper. So that might be.
Here's another thing you might think about. Depending on the credit of the bank, what you might be able to do, credit of the bank, the credit of the company, what you might be able to do is get the company to get an operating loan first so that the cash is there, and then make the sale after with including the cash, and then use that cash to pay, to pay her if there's a way to do that. It's kind of complicated, so we'd probably have to, you could either chat with Grant about the mechanics of it, or we'd have to hop on a call. You probably have a hour or two of planning to make that happen, but that's something that could work as well.
Okay.
To put some cash in. Yeah.
Okay. Thanks.
Okay. Yep. You're welcome.
Okay. And let's see here. The next one was going to be, Linda, I think we answered your questions, correct? You had a question?
Yeah, sorry, it looks like there's a whole lot of questions coming after me. I was asking about a completely separate thing, about the deal platform. If you compare, going after a core platform business and then bolting on versus scaling versus, doing a roll up of many similar businesses smaller businesses in the same industry, and pulling together a business that would be growing that way versus vertically integrating. For first-time deal makers, Roland, do you have a feeling about, what is the easier, better?
Yes. Yeah, absolutely. The easiest thing is to get your core platform, and then and the private equity platform then acquire thing is it's not completely different from a roll up. A roll up, basically, where you're going out and buying multiple companies. I think the roll up is always harder because you have so many personalities to deal with on an ongoing basis, usually, because you're not usually merging all those in and getting rid of all of the operations under. You're literally bringing in 5, 8, 10 complete different cultures and companies, and is really tough. So the easiest thing to me is going around the initial wheel that we talk about and acquiring assets like media, acqui-hires, services and products, that kind of stuff, consolidating, doing that vertical integration, consolidating the supply chain. That's way easier because you're getting something that you don't have to worry about so much integration, right? It's more natural that way. It's easier. They're usually smaller. The value boost is huge because if you're talking about increasing your margin or increasing your lead flow or the number of things that you have to sell by going around that wheel, I think that's faster and way easier. So I would do that as my first stuff.
That's interesting. I mean, for me, because my background's in retail and, running big chains of stores.
Yep.
The idea of a hub and spoke setup and then pulling out synergies from all these individual little mom and pops and then, scaling it up that way seems like a natural, but it seemed more complicated to me too. I mean, do you think, because to me, it's all just the same hub and spoke thing, whether they're, hair salons or restaurants or retail or, I don't know, acupuncturists or something in the medical field. Am I misguided thinking that?
No, not at all. But I think, I don't think we're saying anything different. I think basically, if you think about, if I can acquire assets that are going to provide additional value to the company that I've got, that's the easiest thing to do first. Then the next thing is, if I'm going to acquire companies as opposed to assets, then because the assets that you acquire typically go into the existing infrastructure of the company that you've got. So integration's not really hard. You're not taking a completely different culture and bringing it in. Then the next thing would be the bolt-on. If there's a bolt-on business that you can acquire that's going to add value to yours, then that's going to usually run as a separate unit, but doesn't need to be integrated. If you're going to do acquire, like in a hair salon thing you mentioned, right? So if you've got a core service company that's going to be a holding company that's going to own a bunch of hair salons, it's almost like a franchise ideally there, right? You're either looking at, we're going to let them continue to do what they do because cosmetologists are notoriously responsible, financially savvy people. So we should definitely have them running all those companies with no guidance from corporate. Or you're going to say, like a franchise, okay, here's our systems. Now this is our POS and this is our distribution system. This is the supplier that you're going to buy from now. These are our approved, whatever's SOPs, suppliers, etc. And that's going to be the kind of the next level up. Hey, you're independent, but here are our rules. And then to me, the hardest one is, okay, we're going to buy all y'all and we're going to roll you up in. And now you come under our entire corporate infrastructure and you're part of one company. So to me, that's just like on the level of hardness. You can accomplish kind of the same thing. It's just, those are the increasing levels of difficulty, but they're all great strategies, right? They all work when executed appropriately.
Yeah. Okay. Thank you.
Yeah.
All right. The next one is from Christopher Parker. He says, I was tracking a media company that I found out was acquired by a PE firm in 2018. The fund closed in 2018. I found the SEC Form D, but that did not describe the planned duration. Is there a public document to find out the term of a PE fund, or should I just give up? I think you said that sometimes you can get a deal if the PE firm is nearing the end of its fund duration. So
let's see. You found out that a company was acquired by a PE firm in 2018. And I see also that he can't talk, it says.
Right.
Was acquired by a PE in 2018. So you don't know where it was in its lifetime, in its lifespan that it did the acquisition, but probably less than halfway through would be my guess. The fund closed though in 2018. So if you mean that the fund actually stopped existing in 2018, or do you mean that the business buying the business that it bought, the deal actually closed, the closing was in 2018? That's the first thing. It wouldn't be on your Form D, most likely. But what would be on the Form D would be the principles. So I would be looking at who to contact. You could certainly contact the law firm that probably, or the service that filed the Form D. Form D is a form you have to file in each state, typically, and with the Securities and Exchange Commission in the United States when you do a private offering, that's as opposed to a public offering, to get a safe harbor from not having to do a full registration statement, for everybody that's curious as to what we're talking about. So that's a place to look for the information. That would be my starting point for the investigation. I wouldn't give up though. I would just see if I could find out what's the name of the private equity fund, who are the principals, can I locate them, and then reach out to them and say, I'm interested in that media company that, I think it was a media company. I'm interested in acquiring the media company that you guys bought a couple years ago. And do you still own it? It looks like the fund is done. Did you sell it? What's going on with it? That's just part of your research when you're looking at working with a PE company to find that information out. But I'm not aware of any requirement that they have a public filing of what the term of the fund is, because it's a private fund by definition.
Kevin Yoder says, I like the idea of using a VA to help with deal flow. Can you share how you would use them effectively?
Yeah, so what I would do is, like with any standard operating procedures, I would say, here's what my process. So Kevin, you've got your own process for how you receive and analyze and identify deals. So the way that I would go about it is I would say, let me document that process. What are all the things that I'm doing right now? How am I sourcing deals? How, what do I do to find them when they come in? When the first inquiry comes in, the first response to whatever I've sent out, what's my process there? And then when does my unique genius come in? When does my thing that I need, like, when do I need to come into the deal? And then everything that's before that and everything that's after that, to me, is appropriate for your VA. So whatever your process is of outreach, of identifying companies, of doing the outreach, once you've done it yourself, then the sooner that you can pass that off to somebody else, the better off you're going to be. Does that give you what you want, or are you looking for anything additional to that, Kevin?
That was helpful. The part about passing it back off, that, could you go a little bit more on that?
Yeah, it's very similar to, in sales, we typically have setters and closers. So the setter is the person that's responsible for getting the appointment and calendaring it for the closer to talk to. So in that analogy, you are the closer. So when you get to the point, like you've identified, this is the process for finding deals, and then somebody responds, and at what point do you need to talk with them, right? Now, if you don't have a whole lot of deal flow, you probably want to talk to them pretty soon, right? But you also don't want to waste your time. So if you've got your criteria, like we talked with Linda, it's like, you could gather the preliminary information even, and have your VA either the deal comes in and it's time now for the VA to walk away and set an appointment for you to talk to the seller so you can have that initial rapport building conversation, or the setter's really good at rapport and stuff. And so the setter's basically saying something rather than being an admin. They're saying, hey, we at Yoder Equities are interested in companies like yours, and you came to our attention. That's why I reached out to you. Tell me the story of your company, bond, make notes, etc. Fantastic. I want to gather a little bit of additional information about the company to see if this might be a fit for us together. Can we talk about that now, or should we set another time to do that? Let them do all of that, right? And then go through the information. And then when they've gathered that preliminary information, bring you in, oh, fantastic. I talked to Mr. Yoder, who is our senior partner, and he's definitely interested in this deal. And so I'd like to set a time for you and him to talk about how you could move forward with this, right? That'd be keeping them in until the very, very last possible moment. So you just decide based on how busy you are, where you want to be in that process and how much of that you want to have somebody else do. The pass off is very easy though. It's just, hey, I'm going to bring in my senior partner.
Okay, thanks.
Or my portfolio manager or my managing director, because partner for legal reasons, you're probably better off not to use that word.
Awesome.
Okay.
Todd Schuler says he was approached by another Epic member who has a LinkedIn platform of 88K of entrepreneurs worldwide, mentoring and providing leads. Been in business for 15 months, approached by a large payroll provider to SMBs to market on his platform. He wants me to do M&A for his firm. How would you work with someone like this, or would you?
Okay, give me that one more time.
I was approached by another Epic team member who has a LinkedIn platform of 88,000 entrepreneurs.
Okay.
Mm-hmm.
Okay.
Mentoring and providing leads. Approached by a large payroll provider to SMBs to market on his platform. He wants me to do the M&A for his firm. How would you work with someone like this, or would you?
I mean, generally that is a source of deal flow. I guess it would, the first thing would be to have a conversation about desires and expectations and find out what exactly is the thinking, and how can we work together? How do you see that looking? That's the first thing I always like to do, and then decide if that's something that makes sense to you or not, or if not, what changes would have to happen to make it make sense to you, to have it be part of your deal flow. I mean, it sounds like a great opportunity to me that's worth pursuing for sure. And if you want to pull them up, I can, we can have a conversation and see if there's more specific questions, but I would definitely pursue it. So help me understand what you're looking for from me so that I can give you what you need.
Todd, do you have any other questions? Okay. Awesome. The next one is Victor Pena. He says he's interested in buying a Facebook group for his media strategy. However, he doesn't want them to know that he's the buyer. Have you ever done an anonymous purchase of a Facebook group, and how could he accomplish that?
I mean, yes, because I don't usually talk to the people anymore. So it's, if you want to do it anonymously, the only thing I'd be concerned about would be if it's your mortal enemy and you're acquiring their Facebook group, or it's a competitor that owns it. And I like transparency, and honesty is the best policy first. Then I would go back to the Disney example that we use, right? Is when Disney was acquiring a bunch of properties, sometimes people are opportunistic against somebody who's trying to build an amalgam of property or properties. And so if you're concerned that you're buying up Facebook groups in that and you don't want them to find out it's you because it's going to cost you more or something like that, there's not like a moral issue, then I would consider doing it anonymously. And then it's just having the best thing would be to have an attorney reach out. That's the easiest is, hey, I have a client that's interested in acquiring this group, and the client can be, your SPV that they haven't heard of. It's XYZ Co. Oh, great. who is that? Well, that's, it's the company. They're interested in making the acquisition. I'm representing them, so I'm the person you're talking to. Is it something you're interested in doing? That's pretty easy at that point. Just have a representative do it for you.
Maxim asks, which business would you consider as a valuable acquisition target when your platform is a lead gen digital marketing agency? We still don't have it, but we're working on a strategy. So what would you recommend?
Okay, I'm gonna, as I often do, I'm gonna answer more of the old question before I answer the new one. Just if you were thinking, by the way, like if you were aggregating assets that were media assets on a regular basis, and you didn't really want people to know what your ultimate company was that was going to have it for whatever reason, just be sure it's not a moral reason. If that's the case, then what you might think about doing, and you're going to do this regularly, would be set up a separate company that is effectively a brokerage or its own private equity company, and just say, hey, we're in the business of buying Facebook groups. Yours met our criteria because it's in the hairdressing industry and you've got, more than 10,000 active users. If it's something you'd be interested in, let's have a conversation. Then basically it's the brokerage. So you can stick effectively another company in between you and the company that's actually going to end up with ownership. So that would be another way to do it anonymously, would be just set up a company, hire somebody that's the face of that company, let them do the dealings. So then, they're getting a call from Mary Smith, hi, I'm Mary Smith at, Facebook Acquisition Partners. And you don't call it that, please, because then Facebook will sue you. And at Media Group Acquisition Partners or some generic thing like that, we noticed that your Facebook group has grown, and we're very excited to tell you that it's something that we would be interested in acquiring for our portfolio, and then make the acquisition and then just send it off to whatever operating company you want after that. That'd be another way to do that. Sorry, Deanna, I just wanted to, that would be another way to do it. Very, very easy. You wouldn't need an attorney. You just have somebody basically that's going to be your face of that acquisition company. So now we can go to the new question.
Okay, so it was Maxim has wants to know, what business would you consider as a valuable acquisition target when your platform is a lead gen digital marketing agency?
Well, I would go around the wheel. It's the things that would be appealing would be companies that had already aggregated the eyeballs and attention of the others. It's always going to go back to that sheet, right? Can I buy media? Can I get infrastructure? Can I get products or services? Can I get consolidation of my supply and distribution chain? And is there intellectual property? And then in the middle are there other competitors? Those are in every business. Those are the businesses you want to look at first.
Josh Wilkinson says, I was in negotiations for offering copywriting services for a language learning business. The owner ended up not going with my proposal, and I strongly believe I could have at least 2x their business after implementing a few marketing systems. So I'm considering offering to discuss just buying his company. He has 2 other businesses he started and seems like a good potential candidate for a buyout. What would be a good way to approach the situation since he originally turned down his initial bid for a job?
I mean, I would just say, hey, let's say it's Susan. I'd say, hey, Susan, I was thinking a little bit after we had talked about this, and I really did a little bit of research on the company and the industry. I'd actually like to talk with you about the possibility of buying it. Have you ever thought about selling? That's the simple way to do that.
All right, Maxim says, on the butterfly method lesson, you talked about a product launch that you sold 1.2 million in 6 days as an affiliate. Can you share the ways to do that, as it can be a powerful tool to generate some quick cash, and every 1.2 million helps?
I like that. Yeah, I had written a business plan for that, which I think Deanna has. Maxim, she or Maxime, I don't know how you pronounce it, but she can send that to you. And Deanna, if you don't have that, then ping me and I'll see if I can dig it up. That was 10 years ago. So, but interestingly enough, I wrote like a 6-page business plan on it, and all of those things that I did are still effective strategies, believe it or not.
All right, let's see here. Pete Mon says he has a question about.
Oh, wait a minute. I saw just because Maxim or Maxime said that he created an Excel doc that helps to calculate the equity gap multiplier. Would you send that to Deanna so that she can share it with everybody? And I'll take a look at it, and then we'll just, if you don't mind, we will put that in the portal so that everybody has one.
Yeah, sure.
That's great.
I will send it to Deanna today.
And how do we pronounce your name, just so I don't keep saying it two ways?
Just say Max.
Max. All right. A third way. Nice. Okay. I like it. Thank you, Max. I appreciate that. That's very great. Deanna, go ahead.
Thank you, Max. Pete Mon has a question about 100% acquisition versus investing and keeping the founders on as minority partners. Pete,
Okay.
what's your question?
So I was wondering, I'm looking at the growth via acquisition model, as in like kind of push hard, like say buy an HVAC company, then buy another every quarter, just like really be aggressive.
Mm-hmm.
So the question is, if you have an anchor, or is it better to just choose one or the other, one model, like acquire 100% or not?
No,
Because
I would remain flexible. I think as long as you're acquiring control, I would say that the minimum you'd want to acquire would be 60%. But whether and I would say that just be sure that you feel good about the people that are going to have that carried interest. So it's great for them and it's great for you because you need less to acquire and control the business. And then they're going to get a bump up when you take that bundle of stuff and sell it. So they'll actually get a second bite at the apple when that sells. You will want to have a call agreement in the agreement that you acquire, because you're going to need to have the right to acquire the rest of their interest. But that's something you can chat with Grant about on that meeting.
okay, but then in addition to that, I guess my thing is, do they take a piece of the upside just in the increased multiple on, say, their 10%, or so whatever their minority stake is, or are you acquiring businesses under their brand? I guess I find myself sometimes kind of selling this dream or this vision to the seller, that, oh, well, I'm going to come in as a growth partner and you're going to participate in a bigger way if you stick around, if I can convince you to stick around. But I think I might be overselling that and not focusing on just the fact that I don't know. That's what it seems like it starts to get really confusing.
Here's how they benefit. They benefit. So basically, I come in, I buy your company for it. We have $1 million valuation and I buy 80%. I give you $800,000 of value now. You continue to have 20% or 200 of value. I increase the company's value to 5 million. We 5x'd it. That's fantastic. Your 20% that was previously worth only 200,000 is now worth $1 million, 20% of the 5 million total. That's the benefit that they get.
Right. But if we do it further acquisitions, do they participate in those?
If you do the acquisitions typically through their company, then they would, but keep in mind, they would continually be diluted as you make those additional acquisitions, right? So they would at that point have the opportunity to put in more capital. Let's say that you then you've completed that and you use that company that you now own 80-20 together to acquire $1 million company now after that in that company. Well, then you need $1 million to make that acquisition. So they get then typically the ability to invest their pro rata percentage to maintain the percent they've already got, which means they'd have to write a check for 200K, right? Or they would get diluted by 50% and now they would only own 10%. So they benefit from the growth, but they've got to make their pro rata investment in going forward. And that happens in PE deals all the time. So you'll get, like, we've already gotten that, right? In our deals with selling our event. It's like, okay, we're buying this other event. It's going to be this much money. What do you want to do? You have the right to invest and maintain your percentage, but that's going to require you to come up with some cash, or you can just not do anything and you'll be diluted. And so either way, you're going to benefit, but you only benefit if you're going to maintain, if you're going to contribute the assets that are going to help do the acquisition. Does that make sense?
Right. Yeah, it does. It does. Yeah. And then what if you're buying the company on seller debt? There's no cash being injected into the business. Like,
doesn't change anything. The funding of the acquisition is based on the value of the acquisition. So, if you choose to acquire it through creative means, one of the things that they're going to still have to do is come up with their pro rata share of equity to maintain their pro rata interest. It's actually really simple, and I think maybe it just sounds complicated to you, or you're running into a mental block about it. Here's the deal. I'm going to come in, I'm going to acquire X% of your company. As we go forward acquiring other companies, whatever the value of those companies are, you can either do nothing, in which case you'll have a smaller piece of a bigger pie and you'll get the benefit of the growth of everything, or you'll have the right to contribute your pro rata percentage so that you can always stay at your 20%. But you'll have to put in that amount of capital in order to maintain that. That's it. Did I lose you?
I think we lost him.
Okay.
Okay. So we've got 4 more questions and then we're going to call it a good. Really good. Dilip says, Roland, with your previous deals in the SaaS businesses, how far have you gone with due diligence on the tech side? Not all software is built to scale. Most have security issues, which leads to liabilities, IP leakage, etc. High staff attrition rate in industry paired with poor documentation and similar reasons keep me on the fence. Am I overthinking this?
It just depends, Dilip. I mean, we're protected because we're buying through SPVs. So we have not bought anything that, like if we were doing a 10 million plus acquisition, we would probably have a do coding due diligence. We're really mostly concerned with, does it do what it says? Everything is covered in the representations and warranties and the agreement that is on them to take the positive affirmation that it does in fact do all the things that it says. The most important thing to us is typically the ownership, to be sure that they've got the rights to the copyright and the IP is owned by them, because usually we're already familiar with the software because we're buying in an industry that we're pretty up on things. And so it's not generally an issue. So we're not going into that kind of depth.
Thanks, right. Good. I'm glad that helped. Daniel Matthews says, what if your knowledge and experience has been in one industry for 15 plus years, for example, construction? That's his network is pretty much limited to that industry. So how do you partner with someone who has all the experience and knowledge and still make a deal?
To clarify, make a deal in a different industry. Yeah, I mean, it's you just talk to them. I mean, it's Daniel, it's the classic thing of if you're going to go into a partnership and one person has the deal or one person has the money and one person has the deal is probably the most common. In this case, one person might have the deal, you, and one other person might have the expertise. You're just going to talk to them. And then is it going to be somebody that you hire? Or is it going to be somebody that's going to be a partner in terms of sweat equity? Or is it going to be somebody that's going to be an investor? And then the negotiation is the negotiation. I don't have a good way to break that down, but if you have a more specific question, I'm happy to answer it. Or if you've got a scenario that you want to run through.
Pretty much you're saying the thing that you bring to the table is the deal.
Yeah, absolutely. And that's something that people have a really hard time. Like I had somebody I was talking with the other day and they're like, but I don't understand, the investor's saying they're going to put all the money in. So, what am I putting in? It's like, well, what I'm putting in is that I brought you the deal and I'm going to run the deal. And so this is hopefully an analog that'll help is in real estate. Usually there's somebody that's got the money, the investor, and they're either going, and you've got the deal. And if you bring the deal to the investor and say, hey, I've got this opportunity to do this thing, then they're going to say, well, cool. They're not going to say, well, how much money are you putting in? Because you're going to do the flip. You're going to do the rehab and the flip. That's what you're going to do in these companies as well, right? You're running the deal. So what you're bringing to the table is extremely valuable. And if the investor wants to pin you down, and I've seen real estate investors that try to do this, and you just say, no, here's the thing. The value I bring is the deal. You wouldn't have the deal if I wasn't here. If you believe it's a good deal and the return that I'm offering you based on the structure of the deal meets your required ROI, you should do this. And if it doesn't, then don't. But what I'm not going to do is give you 80% or 90% or 100% of the deal and work for you. That doesn't make any sense, right? My value
does the percentage go to that advisor percentage you were talking about? I think it was somewhere around 5 to 10%.
It would depend. If you are going in as if to an existing company and you're taking a piece of that existing company to help that existing company do something, then that's the advisor thing, right? But if you found a company to buy and you're 100,000 short on doing the deal and you need somebody to come in for 100K, then you're not going to give them all of the deal because you've been able to structure it with your deal stack so that you only need the 100K to do a $2 million deal, right?
So what if the person coming in had pretty much all the knowledge and experience and all you have is the deal? Essentially, you would do like I'll take 80 for the deal and I'll give you 10 to 20 for your experience and knowledge where you can help.
Yeah, the easy way to do that is, again, use that equity gap multiplier thing, right? So say, this is what, if you're coming in and I don't have to pay you any money, which I would be very concerned with if that was an operator, but if it's if it's somebody that's going to help you with the deal, it just depends, man. It might be worth 5%. It might be worth 50%, right? It's probably not worth more than 50%. What it's worth is going to be, how much are they going to spend time-wise on the deal, and how valuable are they to the deal, and how vested do you want them to be in the deal? But I don't think there's a formula for calculating it other than to say, what would I have to pay them as a consultant or as an employee to come in and do what they're doing, and then multiply that, out by the number of hours that they're going to have to work doing this thing, give them a bump, for taking the risk, and then apply that to the valuation, just like we do in the equity gap multiplier.
Perfect. Thank you.
Yeah, you're welcome.
All right. And Benoit says, is there any reference on industry profit margins to assess the target performance compared to its peers?
Yeah, I would Google it. There are studies of industry. It's one of the things that BVR offers. I don't remember the name of it, but if you look at BVR industry statistics, if you Google that, it should come up. But I just Google. I'm a Googler of those things. You can find industry profit margins for whatever your specific industry is. They are definitely benchmarked by lots of different trade associations and research services.
Thank you.
I like Brad's thing. He's going to name, he said, this course is so good, I'm trying to talk my wife into naming our daughter on the way Epic. It's not going well. That's funny.
All right. And it looks like the last one we have is Wes Ward.
Okay.
Wes, regarding multiples, firms between 1 million and 10 million would be more 1x to 3x. How do we gain the multiples of 8x to 11x as outlined? Is that realized by going public?
No, it's get company up so their private equity is going to be interested in it. So, typically that threshold, and it's somewhat variable on industry, but that, like, as a guideline, if you're in the 10 million revenue, 2 million EBITDA range, if you're performing at 10 million or more in terms of turnover or top line sales, and your EBITDA or profit is 2 million or more, then you're looking more at those other multiples. Now, you might get higher multiples a little bit lower, but usually that's a decent guideline.
All right, that's all the questions for today, Roland.
All right, well, thank you all for being here. Great questions. Really appreciate you guys taking the time to be here today and also asking those great questions. Go do deals, and we'll see you next time. Thanks.